The Fed just recently cut rates by 50 basis points, which is 0.5%, and this is the first cut they've made since 2020, where the chairman of the Federal Reserve, Jerome Powell, indicated that more cuts are likely in the upcoming months. In fact, there's even more discussion on another rate cut coming soon, where some bet it could be another 50 basis points in November. So by the Federal Reserve cutting rates and expecting to continue doing this into 2025, by doing this, as rates decline, borrowing costs for all kinds of loans should decrease. So whether that be auto or student loans or getting a new mortgage, with rate cuts, that's going to lower the cost for you. In fact, because of this, if you are interested in real estate, it wouldn't be a bad time to get started, because as rates fall, demand for homes increase, which means the prices of homes will also increase. Which, if you can fit this into your budget, you could always refinance if the rates drop significantly. But on the other end, if you have cash sitting in a short-term savings tool, that means that the interest you are going to earn is going to become lower. For example, I recently got an email from Wealthfront stating that they also cut their rates 0.5%, reducing them from 5 to 4.5%. There's many more scenarios similar to this, but because of that, the first savings tool that I'm going to talk about is going to be high-yield savings accounts. For those that have watched my previous videos, you'll know that high-yield savings accounts are among my favorite place to store cash for liquid access, meaning that you can get it instantly, similar to a traditional savings account, but now you're going to be able to earn much more interest. The reason this is important to understand is because if you had a traditional savings account with a company like Chase, they only pay a 0.01% interest on the cash in your account, which means on $10,000 in the account, after a full year, that would provide you an income of $1. Think of this like giving Chase a loan of $10,000 where all they owe you is 0.01% of interest on the loan, where they can then go use that money to make them much more money than 0.01% of interest. Where with the high yield savings account, you at least have more cushion to earn more for yourself, where the one I use is SoFi, which there's many solid options out there, but currently they pay a 4.5% APY, which means if that rate stayed the same throughout an entire year, you would earn $450, which all it truly takes is just a few clicks of a button to make the change. But the interesting thing here that I recently mentioned on another video is that as rates decline, they're going to affect accounts like your high yield savings account, so you may see in the next year or so, it could decline to 4 or 3.5%. No one knows exactly what's going to happen, but if you're one that wants liquid cash for any short-term necessities, or if you're building up an emergency fund, for example, a high yield savings account would do you much better than a traditional savings account like Chase or Bank of America, where you earn 0.01% of interest. So even if rates were to continue dropping, you would still earn more interest with these than a traditional bank account. Now, if you are curious, a high yield savings account is still FDIC insured, which means in the event of a bank failure, your deposits are automatically insured to at least $250,000 at each FDIC insured bank. Fun fact, SoFi allows you to be insured up to $2 million through their FDIC program. The company has close to 10 million users, where they also have many other financial tools like their investing platform that I use for a dividend portfolio that I'm slowly building up over time. Which, by the way, if you want to get started, you can get up to a $325 cash bonus using the link I have in the description below, where you get $25 just for making the account, and then up to an extra $300 depending on how much you direct deposit. The only thing to be aware of here is that in order to keep the rates active in the account, you have to have a direct deposit through an employer, where you could even do DoorDash or Uber, or the other option is to ensure you deposit at least $5,000 into the account every month. Now, if you're one looking for an account with the highest yields, there are many options out there. You can simply Google them, and I'll also leave a savings account master sheet that I have created that has a ton of insight on specific ones, but a few of the highest paying companies right now are PI Bank, Ivy Bank, and My Banking Direct, all at or above 5%. Of course, these rates will change based on economic conditions. But if you want a more known company, there are solid ones through accounts like Discover or Capital One with their 360 Performance Savings. Or if you want to learn about even more options, you could also filter through the platform Raisin for their high yield savings accounts they offer through banks and credit unions. Which, if you are curious, you may see money market accounts as well, which are similar to high yield savings accounts, but with slight differences depending on the issuer. If you've never heard of Raisin, they have over 1 million customers globally, over $60 billion in deposits under their management. They have no fees. All their deposits are FDIC insured, and with them, you only need one account to gain access to all their savings and CD features. It's neat because with Raisin, you can actually get started with just $1 in any of their savings tools, which is where I have a small amount of CDs. So if you're interested in any of these products and you want to learn more, I'll have a link in the description for you. And speaking of that, moving on to the next option is going to be CDs. Now, CDs stands for Certificate of Deposits, which are a type of savings tool where you can get a guaranteed fixed interest rate over a specific period of time, time, where you can purchase CDs through banks, credit unions, and even brokerage firms like Vanguard and Fidelity. The nice part is that most CDs are FDIC insured, but just be aware that the interest you earn with CDs is going to be taxed at the state and federal level. And the typical frames you may see range from 1 month up to 10 years with CDs, and then for brokered, that could be even longer. But the neat thing to understand about CDs and even US Treasuries is the ability to create a bond ladder, especially as rates drop, the longer rates may increase. For example, let's just say you wanted to build a 5-year CD ladder and you wanted flexibility for your cash every year in the case of needing it. That means you would buy 5 CDs that consist of a 1, 2, 3, 4, and 5-year CD. By the time the first CD expires, you would then purchase a 5-year CD in order to keep the cash liquid. A scenario like this would make the most sense if the longer term yields like that 5-year CD were higher than the short-term CDs. That way you could continue to repeat every year, but now you're getting the higher yield CDs every single time. But recently, and still today, we are seeing an inverted yield curve, so the rates on short-term CDs are actually higher compared to long-term. So recently, using only short-term CDs would have provided the highest returns and the most liquidity to continue having this flexibility with your cash, which is super nice, but in time, the yield curve may change to the longer-term ones like 5 or 10-year CDs being much greater than a 3-month or a 1 year, and if that's the case, creating a ladder with flexibility like that would be much more beneficial. Although this isn't something to rush into, just understand that if short-term CDs decline and the long-term ones increase, you wouldn't be able to get as best of a deal with only doing short-term, where if you did a ladder with like a 5-year CD like I just mentioned, that could be much more beneficial. And also with traditional CDs, understand that if you have to withdraw early, you're gonna have to pay a fee. If you are someone worried about that and don't even want to take the chances, there are no penalty CDs where you could sell them at any time without any penalty. But the disadvantage with that is that you would get a lower rate with the CD and you can't get them for as long of terms. For example, looking at the options strictly through Raisin, you can see they don't have many options for long-term CDs, and the longest one is only 48 months, but their highest earning option is 4.99% for a 1-month CD. You can scroll around to see what may suit you the best, but for no penalty CDs, their longest option is 14 months at 4.3% of a yield, where the highest yielding one is 4.6% for 4 months. So if you for sure know that you will not need to withdraw, locking it up in a traditional CD could potentially get you higher rates. And just so you know, there are many other options that you could look into CDs, like other banks, credit unions, and even brokerage firms like Fidelity, where they show their newly issued CDs in the range of 3 months to 10 years. You can also filter out and look at the secondary market CDs, which are ones you would buy from someone else who already owns the CD, where you could get slightly higher rates and more flexibility with these. So knowing that, let's move on to the next option. That would be through government bonds. To avoid this being an hour long, select bonds that you could consider getting would be treasury bills, notes, bonds, tips, I-bonds, or even municipal bonds. Now, treasury bills are similar to CDs in the sense of providing a fixed income over a duration of time. But with T-bills, the timeframes you'll see with them range between 4 weeks to a full year. The increments if you purchase through Treasury Direct is $100, but a broker like Vanguard or Fidelity is $1,000 increments. Looking at Fidelity, the rates have declined since my last video on this a few months ago, but let's say you want a 12-month T-bill, currently you could get a 3.99% yield. Besides that, a cool thing to know about US Treasuries, they are taxed at the federal level, but they're exempt from state and local taxes. And if you're curious, Treasury notes are similar to T-bills, but they range from the durations of 2 to 10 years, and then Treasury bonds range from 20 to 30 years. There are also Treasury inflation protected securities known as TIPS, which are long-term bonds indexed to protect investors from a decline in the purchasing power of their money. TIPS are issued with maturities of 5, 10, and 30 years and are considered very low risk, where these can also be purchased through Treasury Direct in $100 increments and can be sold prior to maturity in the secondary market. Another option is I-bonds that are strictly long-term, being a 30-year lifespan, where you can sell them after 12 months, but you'll pay a 3 months interest penalty, or if you hold on to it for more than 5 years, you can avoid the penalty. Currently, the rate for I-bonds is at 4.28%, which these get readjusted every 6 months based on the new inflation rate. The last one I'll mention are municipal bonds that are issued by states and local governments, where these are thought of as loans investors make to local governments to be used for funding public works such as parks, libraries, bridges, roads, and other infrastructure. The neat thing here is that the interest paid is often tax-free, so if you have high taxes, this may be something to research into. Before moving on, if you're finding any value in this content, all I ask is you consider subscribing to the channel for future content content like this. Moving on from there, another option to know about are money market funds. Now, a money market fund is a type of mutual fund that invests into high quality, short-term debt instruments, where the way I like to view this is a money market fund is a low risk option for you to park your cash, earn interest, and maintain easy access to your money, which the only place that you can purchase a money market fund is going to be through a brokerage firm. For example, Fidelity has a known money market fund called SPACs that just recently declined its yield from roughly 5% down to 4.6. This is very similar to the rates for high yield savings accounts because if the Fed cuts interest rates, the rates that you would earn on these are likely to decline as well. Now understand that these are not FDIC insured, but they are still protected through the SIPC that is meant to protect against any loss of cash and securities. And the interest you earn with these is based on the amount you own each day and is generally paid on the last business day of each month. Now there are numerous money market funds that you could actually purchase like a normal mutual fund and you could buy and hold them, but the convenient thing I like about them on brokerages like Fidelity is that they can be your core position, so any uninvested cash is automatically going to be put into a money market fund like SPACs. So understand that money market funds are not meant for building long-term wealth, but are more so a convenient option for you to earn some interest, whether you just sold a stock, you have cash in your investment portfolio, or you are waiting to invest into a particular investment. In the meantime, you can gain interest with a money market fund. If you're interested in more tax-efficient money market funds, I've gone into much more detail on them, especially with Fidelity. So if you want to check out those videos, I'll have them linked in the description below, as well as many other videos related to content similar to this. Then another option you could consider with a lot of these new brokerages are cash sweep programs, where a company like Webull has a cash management account where you can get a 5% APY for your cash to earn interest. Which, if you didn't know, if you want to start investing with Webull, you can get over $60 worth of free stock when you make your first deposit over $500. And don't forget, if you want to get started with a high yield savings account, the one I use and recommend is SoFi, where you can get up to a $325 cash bonus depending on how much you direct deposit. And if you want to learn about other high yield savings accounts, money market accounts, and all types of CDs you may be interested in, Raisin makes this super easy to do, and all you need is $1 to get started, which I'll have both of those linked in the description below for you to get started. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.